All right, let's get right into it. We're going to tackle one of the absolute biggest questions in all of finance. What is a company actually worth? We're going to break down the powerhouse tool that analysts use to figure this out. And believe it or not, it all boils down to one simple core idea. I mean, think about it. This is the question. It's what drives billion-dollar mergers, what fuels the stock market, what the entire investment world revolves around. It seems incredibly complicated, but the central idea, it's actually way more straightforward than you think. And there it is. That's the secret. At the end of the day, a company's value is simply the sum of all the cash it's expected to produce from this very moment until, well, forever. The fancy name for calculating this is a discounted cash flow analysis, or DCF. But, before you can predict the future, you've got to have a really good map of the present. Which brings us to our first section, the foundation. Because to value a company, you can't just make things up about the future. You need a solid financial blueprint that shows you exactly how the business runs. This is that blueprint. It's called an operating model. Think of it as this super detailed machine that connects the three big financial statements: the income statement, balance sheet, and cash flow statement. You plug in a bunch of assumptions, things like how fast you think sales will grow, and it spits out a forecast for how the business might look in the years ahead. And this blueprint, everybody uses it. The company's own team uses it for internal planning, and outside investment bankers use it to kick off their valuations. Why? Because it forces you to understand how all the pieces of the business, revenue, costs, assets, actually fit and work together. Without this, any DCF you build is pretty much just a shot in the dark. Okay, so we've got our blueprint and we're ready to forecast all this future cash. But there's a catch, right? The future is by definition uncertain. A dollar you hope to get 5 years from now isn't a sure thing, and we absolutely need a way to measure that risk. Of course not. The answer is a clear no. Cash you expect from a steady, predictable business, that's way more certain, and so it's more valuable than cash from a super volatile company that just gets tossed around by the ups and downs of the economy. We have to be able to put a number on that difference in risk. And the tool we use for that job is called beta. The easiest way to think about beta is as a stock's volatility personality. It tells us how much a company's stock price tends to jump around compared to the entire market. A high beta means it's a wild ride. Higher volatility, higher risk. And here's that idea in action. You've got a food company on one side, low beta. People always need to eat, so its business is pretty steady. Then you have a luxury car company, high beta. When the economy's booming, they do great. When it's not, they get hit hard. This one little number is so important because it's what connects a company's risk directly to what investors expect to get paid for taking that risk. This is one of the fundamental laws of finance. It's just common sense, really. If you're going to put your money on a riskier, high beta company, you're going to demand a higher potential reward to make that bet worth your while. And that demand, well, it has a formal name. It's called the cost of equity. This is the minimum return that shareholders are saying they need to invest in a company. And it's calculated using a formula that has that company's beta right in the middle of it. So a higher beta automatically means a higher cost of equity. Simple as that. So let's recap. We have our financial forecast. We've got our way to measure risk. Now we can finally put all the pieces together. It's time to walk through the DCF calculation itself. First things first, a really important distinction. Which cash are we actually counting? There are two main flavors. Unlevered free cash flow is the cash the business generates before paying off any debt. It's available to all investors, so using it gives you the enterprise value, the value of the whole company. Levered free cash flow, on the other hand, is what's left for shareholders after debt gets paid. That leads you to equity value. For most big valuations, we start with unlevered. So here's the journey, in 5 steps. 1, we use our blueprint to project cash flows for, say, the next 5 or 10 years. 2, since the company doesn't just vanish, we estimate a terminal value for all the cash it'll generate forever after that. 3, we use our risk measure to pick a discount rate. 4, we use that rate to pull all of that future money back into today's dollars. And the last step, you just add it all up. Now, hold on. Let's pause on that terminal value thing. This is huge. It's supposed to represent the value of the company for all of eternity, assuming it grows at some slow, stable rate forever. The crazy part is, this one number, which is just an educated guess about the distant future, often accounts for more than half, sometimes even 80% of the company's entire value in the DCF. It's a massive, massive assumption. And that brings us to our final, and honestly, the most important part of this whole thing. We've been talking about muddles and math and calculations, but here's the reality check. Valuation isn't just a science, it's very much an art. Because every single step we just walked through is completely dependent on an assumption. What's the revenue growth going to be? That's an assumption. Profit margins? An assumption. The discount rate and that giant terminal growth rate? Those are enormous assumptions, and the final valuation number is incredibly sensitive to even tiny changes in them. This table here is called a sensitivity analysis, and it shows you just how wild things can get. Look at this. At an 8% discount rate and a 3% growth rate, we're valuing the company at $1.6 billion. But just nudge that discount rate up to 10% and trim the growth rate to 2%, and the value craters to $800 million. It gets cut in half, all from tiny little tweaks to our best guesses. And that's really the big takeaway here. A DCF doesn't give you one magic, correct answer. It's a tool. It's a powerful framework for thinking through what really drives a company's value and for coming up with a reasonable range of what it could be worth. The final number is almost less important than the story your assumptions tell. So I'll just leave you with this to chew on. If a company's value is so incredibly dependent on our guesses about an unknowable future, what does that really say about what investing is at its core? It's all about using logic and reason to place a structured bet on what's to come. Thanks for joining me for this explainer.